Welcome to Wyckoff Power Charting. I'm Bruce Frazier, your host, and we are going to continue with another Wyckoff workshop. This is part 2 of Anatomy of Distribution, and we are going to continue with case studies and more discussion on distribution, how it works. So today, our agenda is we're going to briefly discuss the distribution versus reaccumulation paradox, which is interesting and important to us in our analysis. Then we're going to have a discussion of phase analysis with specifically a discussion of the phases of distribution. There's phases for accumulation, reaccumulation, redistribution, and in this case we're going to focus on the phases of distribution and over time get to the other important studies. In my personal opinion, phase analysis is what makes Wyckoff method somewhat unique compared to other chart reading methodologies. It creates an element of context, so that it allows us to see the evolution and the progression of a trading range area from beginning to end, and helps us to sharpen our analysis and where we should be taking positions. So this is a very important material in my mind. And also, once we get the hang of it as Wyckoffians, it helps us to achieve a level of mastery and be on the mastery path as we get better and better at this. Finally, we will conclude with some case studies, which is a lot of fun. I like to do those. This is a chart that we have looked at in the past, so I'm certainly not going to spend much time on this, except I just want to make the point that in accumulation, the beginning of an important uptrend, it's a period of trendless markets. It's a trading range that is bounded, where accumulation is taking place by the large informed interests that are building huge positions in the stocks that they want to own. And so these are the innovators, the early adopters. When they are done, they have absorbed the shares of the stock or the market. They've absorbed those, and the absorption makes supply diminished. It makes a slight increase in demand, produce an uptrend in the market that can go on for months to years. Distribution is similar in that it is also a trading range, and this is a preparation phase. This is a trendless period in the market. It comes at the end of a long markup, and this distribution area is pronounced by trendless trading. But there's a key difference, and the key difference is that where absorption was occurring in the accumulation area by large informed interests, when we get to the distribution area, we have a diminishment of interest by the composite operator. They are holding large positions and are interested in distributing those large interests, those large holdings, to others. And in this case, it's going to be largely the public, other institutions, and so on. As they distribute, they have to do it very carefully, stealthily, and what gives them the cover to distribute is remarkably good news. So you have rising prices, you have glowing good news, you have bullishness by analysts, you have just generally a positive environment that the composite operator can stealthily sell their shares into. And so this creates quite a conundrum, because down here under accumulation you have generally no news or gloomy news, poor economy, trendless markets, bearishness here you can see the contrary opinion scale is fear. Over on the other end of the scale is greed, and this is near the highs. And so we want to be contrarians. We've discussed this in the past. The important thing I want to say here is that we're evaluating trading ranges, trendless markets. The other important trendless market that we would consider is the reaccumulation area in the markup phase of the business cycle model or the stock market model cycle. And over here is redistribution. And so those are also trendless trading ranges that we are very interested in mastering our analysis of. Okay, so the distribution versus reaccumulation paradox is quite important in that it's both trendless trading range areas are stopped the same way. With reaccumulation, we are stopping an uptrend and going into a long trendless period of time, could be weeks to months to a year or more. And in this trendless period of time, you are shaking off the shorter term trader types, the weaker holders that aren't interested in the long-term uptrend, and the composite operator who is very devoted to the stock, the theme, the uptrend, will happily hold through this period and will reaccumulate shares, accumulate additional shares as prices get ready to go into a new uptrend. Notice that the volatility is generally coming out of a reaccumulation area because stock is being absorbed. One of the effects of stock absorption is reduced volatility. In the case of distribution, you're also in a trendless trading range, the difference being that volatility is increasing as you go deeper and deeper into the trading range area. Now, what's the paradox? The paradox is this, is that under distribution, you stop an uptrend with a buying climax, an automatic reaction, a secondary test, which also this is considered phase A. Over here, you're doing the same thing. You're stopping a reaccumulation with a buying climax, an automatic reaction, a secondary test. Those both produce range-bound conditions. So we have a range-bound condition here. We have a range-bound condition here. But the outcome at the other end is quite different. So you start distribution the same way you start reaccumulation. And that condition produces confusion, because often what will happen is with less seasoned chart analysts or non-Wyckoffians is that you have under reaccumulation the idea that that is distribution. So what will happen is that there will be a conclusion that under reaccumulation that in fact distribution is occurring and the uptrend is over. And what we want to do is identify the footprints and the preconditions of reaccumulation for another uptrend. We love reaccumulations because we'll have a number of them that will occur in an ongoing markup period from accumulation to distribution, where think about the market cycle model. You only get one accumulation, you only get one distribution in the market cycle model, but you could have a series of reaccumulations on the way up. You could have a series of redistributions on the way down in the markdown phase. So this is why we're so interested in the reaccumulation phenomenon. So here in distribution, the difference is that you have ever increasing volatility as stock is going from strong hands to weak hands. The net effect of that, the cause of that volatility increasing, let's just sort of draw that condition here. You can see that increasing volatility there is because stock is being transferred from strong holders to weak holders. Weak holders will hold the stock into the markdown phase, and in many cases, sadly, will hold it all the way through the markdown phase. This is something that we as Wyckoffians want to be very aware of and not do. We do not want to be what is some in the industry called bag holders. So, okay, the reaccumulation paradox. So here, just so that you can see this, how does reaccumulation and distribution start in the same way with this phenomenon. Buying climax, automatic reaction, secondary test. And so we want to understand what occurs after that. And that's why we do phase analysis. So here you can see that we have done, in this case, we studied this 2003 Dow Jones Industrial Average distribution phase that occurred. And I'm just going to point out a few things here because we're really interested in the phase analysis. Phase A, phase B, phase C, phase D, phase E. And so we can see here that we have a buying climax, automatic reaction, secondary test. And that stops the uptrend. You can see that's exactly what's happened here. So we have a range-bound market, and this range-bound market has resistance and support drawn over the buying climax under the automatic reaction, and we have a trading range, just as we described in Dr. Pruden's adoption diffusion model. And so now our job is to analyze the trading range area to determine whether or not there are elements of distribution here or reaccumulation. We can see that what's happening is, as we can see in this model, is that volatility starts to really take off. Phase A is what we just described, buying climax, automatic reaction, secondary test. And then we can see that there's a lot of volatility that takes place in phase B. Phase B is typically the widest phase. It is where we build point and figure count. For those of you that are point and figure aficionados, this is where the count gets really big, and it's trendless trading. We as traders, we as Wyckoffians do not want to trade in phase B. We just don't trade in phase B. Why is that? It's because it's a trendless period with a lot of volatility, abrupt swings up and down that will catch stops, which will create all kinds of grief. And if you trade through phase B, you will find yourself so exhausted when you get to the end that when the good stuff comes, when the trend starts, psychologically too exhausted to participate in that trend. So here's where phase B starts. We draw a downward line here. So that was phase A. Phase B starts here. It goes up to the last point of supply. Last point of supply is the last place that the market rallies to before supply engulfs it and takes it down and out of the trading range. Now, we will often, if we can, identify the onset of phase C, which is where the action starts. So this is phase C, and we would either attempt to trade the LPSY as it touches this supply area, or ideally this test. You can see there's a test right here. And then there's another test right here as it gets ready to accelerate downward. Actually, the test is all along here. And that's another place to initiate, because you can see that the weakness is coming in. Volume will tend to be high, volatility is wide, lots of supply present. This tells us to be on our toes because trouble is starting. Okay, and then look what happens. Major sign of weakness follows as the decline in price of this index goes down below the support area and breaks that down, attempts to rally one time up in to produce another last point of supply with a test. Test is a good place to put on a trade. So maybe tranche 1 here at LPSY 1, tranche 2 at the test of LPSY 2, and then downward into an important decline. Okay, so that's phase C, is where we have the final testing of the trading area before the markdown begins by producing an important sign of weakness. And phase D is the actual downtrend, which occurs from here forward. And we have this important downtrend that phase D takes us down out of the distribution trading area, and phase E is the markdown phase that comes after distribution is complete by its exiting the trading range. Okay, so let's go onward. I just want to show you this. We're not going to do phase analysis on it. We looked at it last time. but here is a inverted V-top. There is supply being put on the market on this hypodermic type rally up out of this trend channel, which is unsustainable. There is supply present all the way up, selling on a scale up by the composite operator. This is where we can really see the distribution, is when we get these tests, attempt to rally after touching the top of the channel, attempt to rally. This is the distribution that is also being, you can see selling on a scale down off the peak. And so trouble is taking place. We want to learn how to study these and participate in them. They're somewhat rare, but they're important for us to know about. Okay, so here's the current market environment as we saw in this blog on March 5th. I talked about this on Market Watchers Live on March 7th. You're encouraged to go look at this, but here is a period that has elements of distributional nature, but we're still in the trading range. And so here we see buying climax, automatic reaction, secondary test. So phase A is complete. So let's just draw a line there. And then we can see that there's an upthrust that's occurred. Now we're thinking that this may not be over yet. So you can see over here, this we're thinking might still be a phase B period right now. We're still in phase B, which two things could happen here. Well, and the other part is this could be reaccumulation, and we discussed this in the March 7th Market Watchers Live. So please turn to that to look at reaccumulation. We're still open-minded about the possibilities here, but there are elements of distributional nature in the way this is trading. The volatility is high, it's gotten higher, big swings down, big swings up. So we're thinking that possibly we're still in phase B with this upthrust. So we have an upthrust here. You can see on our distribution schematic, an upthrust here. So one of two things could happen after this big sign of weakness is that we had an important rally that went up to the resistance area, and it's attempting to pause there, that this could be an LPSY, which would be a phase C type event. So this could be phase C. The other thing that could happen is that we could run up into an upthrust after distribution, which goes to another minor new high, and there is where phase C concludes. So we have two scenarios that we could work with in the distribution structure that still are possible. So this area of trading may not be done yet. Now, we'll have an open mind about reaccumulation and absorption of shares coming, and we talked about what would have to happen to price and volume to demonstrate reaccumulation is starting to take place, and that this rally that we've just been through is part of a bigger rally structure. So, okay, so go to this blog here to get these schematics, print them off, put them on your wall, refer to them often as you look at your charts. We're going to look at this schematic here. Maybe, oh, I wanted to show you how you could get this, because there's these nice definitions of the areas of distribution in the phases on this chart. And so go to this blog. At the bottom of the page is a link to the article, which was written by Prudin, Bogomazov, and myself, discussing this among other things in point and figure analysis. And so have a look at that and maybe print that chart off. Okay, let's get into case studies. And here we can see this is Decker. This is a classic example of distribution with an upthrust. This was from 2013. We can see a buying climax, automatic reaction, secondary test. Phase A is complete. That's this blue vertical line. So then notice what happens is that on a rising scale, you can see volatility increasing and this crazy sort of trendless trading area in phase B, which has lower lows and higher highs. So we consider that to be a condition of distribution, volatility increasing. And so far, we are thinking distribution is what's at work here. And then we have a run up to the upthrust after distribution, which is one last attempt to go to new highs. Now, look at the thrusts to minor new highs throughout this trading range area. And these are thrusts that are generally diminishing. This is a loss of momentum in this stock after a really profoundly good uptrend with a climactic surge that comes, and we're considering the possibility of reaccumulation. But so far, as we go through phases A and B, it doesn't look like reaccumulation is asserting itself. Then we have an upthrust and a failure. Well, here's the test. So upthrust and then a failure. Now, it hasn't come back into the trading areas marked by the buying climax resistance or the automatic reaction support, but it has fallen off here and has had a failing test. This is a classic place for short sellers to put on an initial trade. And so this test of the UTAD is results in more price weakness, which is really would cause us to be concerned, because now it declines easily and effortlessly back down. And this also, notice the volume is high. So this shows supply is present. Look at the attempt to rally after this break. The rally is of poor quality. It has very little lift in it. There's just basically sideways action as it goes up to the resistance line, attempts to go through it one time and then fails, and has ease of movement. This is a second place to initiate or add to positions, is on this LPSY. Then the failure goes down. Now we're in phase D. Phase D is after the test, and we decline down and out of the trading range area and fail, attempt to rally up to the bottom of the prior support, which is now resistance, and this becomes LPSY 3. And this is another place to initiate trades. So compare this to our schematic. You can see that there's tremendous kinship, we would say, of the schematic to what actually happened here. And just so that you can get a better look, we'll take the markings off. And now the important thing to say about an upthrust after distribution is it means what it says. Distribution is now over and the markdown can begin. Look at the ease with which the market changes character here and goes into an important decline. This is a persistent long decline that just goes week after week after week downward. So this decline tells us that stock is in weak hands, because if it was in strong hands, it just wouldn't do this. It wouldn't go down like that. And so this really all was classic distribution, where stock went from strong hands to weak hands, and weak hands cannot support this stock. It can move easily downward because it's in the wrong hands. And this is a condition that we want to avoid. All right. Now, just one other nuance that we want to get into is point and figure counting. So here's a point and figure count of Decker's, and we can see that it gave a count across the count line from $32 up to 97 to 116, roughly. And so we would want to be on the alert for distribution forming in the area of the count fulfillment of the point and figure count. And here is the yellow area, which is the area that we counted as point and figure. Here's the count objectives that were formed. And as the uptrend, the markup, which we looked at in the prudent model, as the markup went from accumulation to distribution, we can see the point and figure count flagged where the highs were likely to be for either reaccumulation, a pause for that, or distribution. We just saw it was distribution. And you can see how well the point and figure analysis, the horizontal analysis, gives us a target for where to look for distribution to form. And so this is a beautiful example case study of what happens here. You can see, look at the uptrending channel. The up thrust is actually an up thrust that goes into the bottom of the channel from underneath. The next rally to the up thrust after distribution can't even get to the bottom of the channel. This is evidence of the loss of momentum that we talked about earlier. Another example, so here, just for your own edification, maybe screen capture this and study it. Here are the phases on a daily chart, so that you can see how to analyze the phases as they're unfolding, and then look at the interaction to the channel there. Beautiful stuff. Okay, another one, and I'm going to go quickly through this one. The last two examples were actually stocks that I traded from the short side at that time, and in this case, I want to show you where good places to enter. Here you can see the uptrend continued to go. Higher highs actually keeps investors calm, keeps them in the trade. But notice this, look at the change of character in this decline from the buying climax to the automatic reaction. Huge outsized decline automatically puts us on the alert for a stopping of the trend, trading range, possible distribution. So we draw resistance, we draw support. Sure enough, it attempts to get above that area, has an up thrust after distribution. Where we get busy as when we see price fall back into the range bound condition. It falls in there, it rallies up to resistance. This is where tranche one of the trade was put on. And then there's an attempt to go down, another rally. And this rally is another LPSY of poor quality. And tranche two was put on there. And you can see subsequently that price was weak thereafter, and then just tumbled out of this area and went into an important downtrend. I made a mistake here. I covered tranche one, and believe me, I'm not complaining about this trade. I'm always trying to get better at what I do. Is covered tranche one here, covered tranche two here, but notice the continuation of the downtrend as we were going along. This really suggested that this was profoundly weak. It would have made sense to at least keep a tranche of this trade on for another possible decline, which was quite dramatic and went substantially further. So I did this case study for Market Watchers Live more than a year ago. So this one, I'll just leave this for you to look at on your own time. We're running out of time. I want to show you, and these are the blogs to go to, is I want to show you the transports. And here you can see this is the current transports, and you can see the distribution there. I'm probably going to write a blog about this so that you can see these charts closer, but all the elements are here. And now look at the rally up under the LPSY. JB Hunt, similar. Actually, these peaks in JB Hunt are actually precede the peaks in the transports, and JB Hunt is a component of the Dow Jones transports. So look at the profound weakness out of the channel, attempt to rally back up, probably another LPSY right here. Look at the weakness that came after that. And thank you so much for spending time with us, and we will see you next time. So long.
Join us April 1st to April 5th to celebrate our 20th anniversary here at StockCharts.com with special guests Arthur Hill, Greg Morris, Gaddis Rose, Martin Pring, and John Murphy. Tune in to Market Watchers Live at 12 p.m. Eastern Standard Time during the week of April 1st to April 5th to help us celebrate.